Welcome to vTalkInsight, Risk Sentiment Daily for January 9th, 2026. Global markets are trying to balance powerful AI and earnings tailwinds against a fresh wave of geopolitical and policy shocks, leaving risk sentiment constructive, but far from complacent. Across assets, today's picture is cautiously risk-on rather than outright euphoric. Earlier this week, sentiment leaned firmly bullish, but renewed geopolitical tension and policy uncertainty are now tempering risk appetite even as key growth narratives remain intact. On the positive side, market sentiment remains notably bullish across equities, credit, and crypto, helped by expectations of double-digit earnings growth, strong merger and acquisition activity, and credit markets that have absorbed tens of billions of new issuance without meaningful spread widening. AI remains central to the story, with leadership from large technology and semiconductor names, while breadth is improving as small caps, financials, industrials, energy, and defense stocks join the advance. Offsetting that, investors are reacting to risk-off signals, declines in Asian and European equity benchmarks, elevated geopolitical flashpoints from Venezuela to broader U.S. power projection, and growing concern about domestic policy intervention in housing, buybacks, and executive pay. At the same time, tight credit spreads, signs of stress in private credit, and rich equity valuations mean that any macro or policy surprise could trigger a sharper risk-off move, even though the S&P 500 was effectively flat and volatility remains contained. Overall, positioning and price action point to a market that still leans toward risk, but does so with much more respect for downside tails than just a few sessions ago. AI-led earnings and growth tailwind remains the single most important bullish driver. The U.S. government now attributes more than a third of current GDP growth to the AI boom and is actively coordinating with the private sector to maintain leadership, underlining how central this theme has become to the macro outlook. Market expectations for S&P 500 earnings growth, around the low double digits, are heavily concentrated in big tech and technology-related sectors, especially AI data centers and semiconductors. Analysts argue that Microsoft's cloud and AI businesses and Apple's move to monetize its installed base through AI are still underappreciated, while NVIDIA is poised to regain access to a significant slice of the Chinese market as imports of its H200 chips are approved for commercial use. AI is also creating powerful second-order effects. Data centers are expected to drive U.S. electricity consumption from about 4% to roughly 14% of the grid by 2030, pulling forward demand for copper, on-site power solutions, and advanced memory. Memory prices are already up sharply, helping triple profits for producers like Samsung, and semiconductor capital equipment firms such as ASML are positioned to benefit from both the current memory upcycle and an anticipated logic upturn. There are, however, clear risks to this AI-centric cycle. Equity performance and 2025 growth are now heavily reliant on AI data center investment, and investors are becoming more selective, with the AI trade losing its one-way dominance as markets differentiate between likely winners and losers. Valuations in parts of the complex are rich, and rising input costs or a slowdown in capex could quickly challenge the earnings narrative. The key takeaway is that AI remains the core bullish engine for risk assets, but markets are starting to price a wider range of outcomes, making stock selection and thematic exposure within AI increasingly critical. Another supportive force is the broadening rally into small caps and cyclicals. Market breadth has improved notably, with 9 of 11 sectors hitting new highs and equal-weighted indices outperforming, a marked change from last year's narrow, mega-cap tech-driven advance. Small-cap indices such as the Russell 2000 have beaten the Nasdaq 100 by roughly 4 percentage points in the opening days of the year, marking the second strongest relative start on record. This strength is underpinned by expectations for U.S. GDP growth near 2.5%, potential rate cuts, and a catch-up in small-cap earnings after a long period of underperformance. Participation is broad across cyclicals. Financials, industrials, energy, and defense are all seeing renewed interest. Large U.S. banks are expected to benefit from a backlog in M&A and IPO activity, while European banks look attractive on capital strength, loan growth, and still reasonable valuations. At the same time, global defense stocks have rallied sharply on proposals for a 50% increase in the U.S. military budget, and individual investors are adding to energy and commodity names as geopolitical tensions support oil-related trades. The flip side of this healthier breadth is more rotation and idiosyncratic volatility. Investors are reallocating from mega-cap tech into previously lagging sectors, with single-stock moves becoming more pronounced and implied volatility in tech options rising relative to the broader market. Some managers are already rebalancing portfolios and raising cash after strong small-cap gains, signaling that while the rally is broader, it is also more discerning. For portfolios, the key message is that opportunities are expanding beyond a handful of leaders, but dispersion risk is increasing, making sector and stock-level decisions more consequential. The prospect of Fed easing and a soft landing remains an important, if more debated, support for risk assets. Several policymakers argue that current monetary policy is materially restrictive, with underlying inflation already near target once lagging shelter costs and portfolio fee distortions are stripped out, and they advocate as much as 150 basis points of rate cuts over the year. Recent data help this narrative. Productivity growth has picked up, unit labor costs have fallen, and layoffs and job cuts remain subdued, even as hiring cools and becomes more concentrated in sectors like information technology and biotech. That pattern is consistent with a gradual cooling rather than a sharp downturn and supports the idea that the Fed can prioritize employment if unemployment drifts higher toward the mid-fours without reigniting inflation. The Fed has also moved to address market plumbing, resuming asset purchases to stabilize funding markets and removing a near-term liquidity overhang for equities. Outside monetary policy, lower oil prices, a softer dollar, and ongoing fiscal support all add to the growth backdrop, making it harder to argue for a deeply bearish macro view in the absence of a major shock. Still, there are clear constraints on how far this easing story can run. Some officials see policy as not especially restrictive, and bond markets are signaling that expectations for imminent cuts have already moderated. Long-term yields remain elevated, with the 10-year expected in the 4 to 4.5% range amid sticky inflation, tariff effects, and deficit concerns, limiting room for multiple expansion. Markets are therefore increasingly sensitive to each data release that could shift the balance between a gentle cutting cycle and a longer pause. On the risk side, escalating geopolitical and policy uncertainty is weighing on sentiment. Analysts describe 2026 as a potential tipping point, citing political upheaval risks in the U.S., instability in parts of Europe, and intensifying hybrid conflict between Russia and NATO, all of which raise the probability of sudden risk-off episodes. U.S. policy toward Venezuela encapsulates many of these concerns. Washington is moving to control Venezuelan oil sales and hold proceeds in U.S. accounts, while tightening sanctions enforcement through ship seizures that disrupt flows to China and other buyers. Plans to extract significant volumes of Venezuelan crude and limit exports to specific destinations introduce uncertainty for global supply, even though near-term oil markets still look oversupplied. More broadly, there is a clear shift from economic tools like tariffs toward greater reliance on military power to assert U.S. influence, combined with a willingness to bypass both allies and adversaries. At home, frequent and unpredictable interventions in housing, energy, defense, and technology policy are driving a move towards state-influenced capitalism, with rising populist pressure to restrict buybacks, cap executive pay, and limit institutional ownership of housing. Even in digital assets, geopolitics is intruding. Illicit crypto activity has surged, with stablecoins now dominating sanctioned transaction flows, prompting the US, UK, and EU to use targeted wallet sanctions to disrupt these channels. While some proposals, such as extreme territorial ambitions, face strong congressional opposition and are unlikely to materialize, the overall picture is one of higher and more volatile policy risk premia, particularly for energy, defense, and any business model that depends heavily on government contracts. Rich valuations and concentrated earnings dependence represent a second major headwind. Consensus equity earnings growth is robust, with expectations around 15% and heavily back-half loaded in cyclical sectors, while S&P 500 earnings for 2025 are projected to grow roughly 11%, led largely by big tech and AI-related businesses. Given that backdrop, several commentators argue that price-to-earnings multiples are more likely to contract than expand over the next 12 months. Markets are already punishing earnings misses aggressively, and with valuations elevated in many growth and quality segments, disappointments could trigger outsized drawdowns even if the macro environment remains benign. Higher for longer yields compound this challenge. Despite expectations for central bank rate cuts, long-dated yields remain elevated globally, and the 10-year U.S. Treasury is expected to trade around 4 to 4.5% as deficits, inflation concerns, and questions over Fed credibility keep term premia positive. That backdrop caps how far equity valuations can re-rate without a clear acceleration in real earnings growth. There are pockets where valuations look more balanced, such as some semiconductor capital equipment names and selected financials or home builders that have already seen material estimate cuts. However, index-level exposure remains heavily dependent on a narrow group of mega-cap tech firms and the AI ecosystem, reinforcing the risk that any stumble in this cohort could have outsized effects on broad equity benchmarks. Finally, late-cycle credit and liquidity vulnerabilities are building beneath the surface. Global bond issuance has surged to record levels, with governments and corporates rushing to lock in funding, yet credit spreads remain tight, and markets have so far absorbed the supply smoothly, contrasting with bouts of volatility seen last year. At the same time, there are early warning signs in private credit. A large manager has allowed unusually high withdrawals from a flagship private credit vehicle after heavy redemption requests, and while reported default rates remain low, limited transparency makes it difficult to gauge true stress levels. Regulators are scrutinizing the sector for systemic risk, especially as retail participation increases, even though locked-in capital structures may reduce the chance of classic runs. Capital is also pouring into AI-related private credit strategies, where the race for market share may erode underwriting discipline despite strong margins for leading tech borrowers. Some managers caution that tight spreads, optimism around AI, and the sheer volume of capital being raised could sow the seeds of future losses if growth underwhelms or financing conditions tighten. Even with robust demand for long-duration assets and high real yields attracting buyers today, the combination of rich valuations in public credit, rising alternative allocations, and patchy liquidity argues for greater respect for tail risks. For portfolio construction, this environment suggests that funding conditions can remain easy until they are not, and that cross-asset correlations and drawdown patterns in the next shock may differ meaningfully from prior cycles. To sum up, risk sentiment is still cautiously skewed toward risk-taking, powered by AI-led earnings growth, a broadening equity rally, and expectations that the Fed can ease policy without derailing the expansion. Set against that are rising geopolitical and policy flashpoints, demanding valuation and earnings assumptions, and growing late-cycle credit and liquidity vulnerabilities that could amplify any negative surprise. The balance of risks argues for close attention to policy signals, earnings quality, and credit conditions as the year unfolds. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.